following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views. This is, of course, your weekly source for all things volatility and volatility trading related. My name is Mark Longo from theoptionsinsider.com, as well as the ever-expanding, ever-enjoyable Options Insider Radio Network. And joining me for the old Vol Views program today, starting off immediately to my left, where I guess if I'm facing north, then perhaps New York would be to my right, it would be good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Always good to be here. It's somewhat of a gloomy day. Not only is the market getting creamed, but it's pouring here as well. So a lot of gloom and doom today.
Yeah, it's an interesting one. Not exactly a scintillating day here in Chicago either, but a interesting one from a trading screen perspective. Also joining us on the old Volatility Views panel today is good old Mark Sebastian from OptionPit.com by way of Sesame Street. Mr. Sebastian, welcome back to the program,
Hey,
sir.
how's everybody doing today? Did you miss me?
We missed you terribly, sir, of course. But now...
It's been a couple of weeks. I was on my anniversary tour and, things like that, so...
You did the grand tour of Europe and then off to Asia like they did back in Victorian England?
That's correct.
By way of Cape Cod?
Correct.
All right, and with the gang all assembled, we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. And in case you're joining us for the very first time, and if so, welcome, and also shame on you for missing all of our earlier episodes. But welcome, and this is, of course, the portion of the show where we break down the week's worth of volatility and volatility action. And as Don alluded to at the top of the show here, today is an interesting one. We're seeing, as we're recording this middle of the day here in Central Time, we're seeing a pretty broad sell-off across most of the major indices. S&P down about 1.5%. With most of the other major indices down around that, or even the NASDAQ a bit more, leading the charge down over 2% right now. And not surprisingly, the VIX off to the upside, up about 15%. So, Mark, let's start there. We've talked a myriad times on this show in the past about VIX and its relationship to the weekend and to decay. Traditionally, we would see VIX easing off. So seeing VIX rallying this hard on today of all days really means that this is even a larger move than you see just from a percentage on the screen.
Yeah, I agree. Although, we've been seeing less of this weekend decay than we have in the past. A lot of times there's actually been a weekend premium with then coming in on Monday and vol actually down or flat. So we've been seeing kind of some weird VIX patterns over the last couple of weeks. And wouldn't shock me if we saw something else. VIX is up as we speak about 2.3%. All right. So for those of you that aren't aware, that I mean 2.3 points, but the fact of the matter is the VIX is a percent. And it's always weird quoting a percent of this.
It's obtuse.
It is. But, the interesting thing is if you look kind of at, where November vol is strike by strike, they're not up that much. earlier in the day, in fact, when we were only down about 17, we were really barely seeing any action out of the options at all. And in fact, we saw a large amount of net premium selling. And still, if you look at kind of bid offer trading in the SPX, been a net delta purchase, about 3.4 million deltas bought today. Kind of interesting. I'm a little flabbergasted at what I'm seeing. We haven't had a real move in 4 months, and we've got having an abysmal earnings week, and this is all that we can get out of volatility and out of option prices. And Don's going to have a really good reason why this is all we're getting out of option prices. But I just want to lay that up for you guys.
Well, I guess the weekend takes a little toll, but actually you talked about percentages before. We've got the Dow down almost 200. We've got the S&P close to 23 handles. And on a percentage basis, VIX is up almost 15%. I'm looking at a little delay, but I'm looking at about 14.7 right now, and the S&P down 1.59%. So actually, that's a ratio of 9.25. In other words, the percentage movement in VIX is 9.25 times the downside movement in the S&P. And that's rather substantial. You're looking at VIX and saying, gee, why isn't it even higher still? But those ratios are usually about 4 to 1 on the upside, maybe 6, 8 to 1 on the downside. So when you get a greater than 9% move or ratio of the move percentage-wise of VIX to the cash or to the underlying, that's pretty substantial. So, given the fact that it is that rather large multiple and we're fighting the weekend effect, this is a pretty decent move in VIX, especially since we saw the 13 handle not all that long ago. Now we're at about 17.25.
So, Don, what are you watching here now that obviously NASDAQ leading the charge to the downside over 2%, 2.1% as we're talking right now. So, obviously an intriguing week from a NASDAQ vol perspective as well. So, what have you been watching over in your neck of the woods?
Well, I was actually going to mention the actual diversion. It doesn't happen all that often, but we've talked about how historically NASDAQ is clearly the more volatile of the two indices when compared to S&P. And on the show last week, I think S&P volatility had just dropped below 10 to get into the single-digit area, maybe about 9.6 or 7, and NASDAQ was floating around 12.5 or 6. So I was actually discussing that similarity between the two and the fact that there wasn't very much of a spread, and historically speaking, it's been greater. So an interesting thing happened this week. S&P realized volatility, in other words, historical, actually dropped to almost 9 even, 9.06, trailing 21-day historical volatility, while NASDAQ inched up a little bit into the 13 handle at about 13.1 or so. So that wasn't too much of a surprise, given that there ought to be some sort of a spread between the two. And I would say that that's continuing today, as NASDAQ is down over 2%, S&P only about 1.6. So that ought to make a greater increase in realized volatility for NASDAQ when the day is over with respect to S&P.
Yeah, well, and they're saying that tech has been the leader for so long. And it looks like it's going to be financials now that are kind of leading the way rather than technology, at least certainly with Google and Apple and Microsoft, 45% of the NASDAQ getting, and you throw in Intel, and you're over half getting absolutely smacked over the last week.
Yeah, Apple right now down about 2.5% to trade about 617 or so. Google trading down about 2% following yesterday's massive sell-off. Of course, right. Microsoft down almost 3% on the day today. So Microsoft not traditionally an earnings mover, and they're moving.
2%. I mean, I mean, you throw those guys together and you basically have the whole NASDAQ. Amgen, another big one. Amazon, another big one. I mean, all the tech, sans Amgen, they're biotech. Well, I guess they're a different kind of tech. But you look at all the biotech and, or not biotech, you look at all the technology firms, they're getting pounded. You know, the only real decent tech company that's so far, quote unquote tech, is eBay. And the reason why eBay's doing well is because they're a payment processing firm.
I will say this, Microsoft, I can guarantee will stay above 28.5 today. And the reason I know that is because that's the only remnant of the condor I have left on out there is the long 28.5 puts. So there's no way it's going south of that strike today.
By the way, I would make one other comment, and it's actually in conjunction with an interesting short article that Bill Luby wrote recently, and that was posted, Mark, on the Options Insider network. And that is actually also to speak to the point of how much VIX has gone up and why perhaps not even more. Always have to look at these things on a relative and a percentage basis, not always actually on just a point differentiation. Bill made the point in his article that in the early days, VIX traders were building in rather substantial and huge premiums over realized volatility. That was, of course, a direct falling out of option pricing. And often in the period in the mid-1990s when the VIX index was created, you had a ratio of VIX to realized volatility of about 149, 150%. So for a numerical example, when trailing volatility realized was 16, you might have seen VIX at something like, 23 or 24, 50% higher. And Bill went on to point out that in more recent years, these premiums and the spread have come in somewhat, such that now that difference between the two, or the ratio percentage-wise, is more about like 24%, so in the 20 to 25% range. And we talk about the 4% spread of the risk premium. You'd go from 16 on realized to 20 on implied. That would be 25% over. Or you'd go from 20 realized to, let's say, 24, keeping the same 4% spread, but now you're 4 over 20, or about 20% higher for the ratio. Well, reason I'm mentioning this is because even with today's volatile day, the 9 realized volatility of the S&P is probably going to be in the low 10s. Today we'll jack it up a little bit, but it's only one day out of 21. And I would say that when the smoke clears tonight, historical volatility S&P will be in the low 10s, maybe 10.1 or 10.2. Meanwhile, VIX, as I'm looking at it, is 17.33. It's 7 over 10. So you've got a 70% premium of VIX to realized volatility.
That was what I was trying to get at when I said Don's going to explain to you exactly why the VIX isn't moving as much.
So there you go. That, at least in my opinion, it's moved enough. It's moved a great deal.
Yeah.
And I think Bill Luby, would kind of agree. He said, "Holy smokes, it's 70% over."
Unless we're set for these days for the foreseeable future. Correct me if I'm wrong, but I believe today is the first real substantial north of 1% down day that we've seen since about June.
4 months. In 4 months. This is the first time we've moved more than 1% since June 26th.
Wow,
on a down move.
Incredible.
1% down. I know he moved 1% up, but 1% down,
yeah. More than 1% on a down move since June 26th. It's absolutely incredible.
And Don, this gets to your point too of vol being so biased to the downside, because it's been bid up with upside vol for so long. Now we're dropping to the downside, and now you're saying the 70% premium. That just shows you how it's still so heavily biased. One substantial down move in 4 months is enough to cause this.
And we're going to have a very interesting guest on the show in a moment, and he's going to talk about some research that we did and a paper that he authored with using VolContracts to kind of overlay an equity portfolio. And this was, in fact, one of the main points, that the correlation of, or the negative correlation of, if you will, of any kind of a volatility product to an equity portfolio is substantially stronger to the downside than it is to the upside. There's still negative correlation to the upside, but it isn't as dramatic in terms of movement as it is when you get these indices moving to the downside.
That's a good little tease there, Don. So I think with that, we're going to close out our volatility review segment and dive right into a very, very interesting conversation with Nick Lee.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that music means it's time once again for the Volatility Viewpoint. This is the portion of the show where Don and I welcome a guest onto Volatility Views, and we take the opportunity to pick their brain on some aspect of volatility analysis or research or volatility trading. And today, Don and I are very pleased to welcome onto the show Nick Lee. He is a quantitative analyst over there at VolX, has been doing some very interesting research. Nick, welcome to the program.
Hi, thanks. Hi, everybody. I'm Nick, and I go by Nick, and my Chinese name is Sixiang Li, and I'm now working for VolX as a quant, and I have a master degree in IIT, majoring in mathematical finance. Thanks.
I like it. You've listened to the show before. You anticipated my questions there, Nick. And yeah, don't mind if I call you Nick. It is a little bit easier. But yeah, like as we are wont to do here on the show, whenever we have a newcomer to the program, we like to give them an opportunity to relay to our listeners a little bit of their background in the field and how they, because it is a very specialized area of expertise, how they got to this area of research. So give our listeners a little bit of your background in the options and derivatives worlds and how you found your way to working with VolX in this very specific area of research.
Okay. As you know, I have a master degree in IIT, majoring in mathematical finance, and we basically study how to price derivatives. How I meet the VolX people is once they come to our school to hire an intern, and then I approach them after the lecture, and then I think I can make a positive contribution for VolX, and that's how it works.
And Nick, you are currently working on a very interesting paper. I think it's fair to say it's still, I wouldn't say beta, but it's still under development. But there's a lot of interesting analyses that have gone into it. I think our listeners will find this very interesting. The paper is titled VolContract Futures Overlay on an S&P 500 portfolio, and as our listeners might be able to deduce from that title, it's an interesting analysis you've done comparing some of the different implementations of using vol contracts and using them in different ways in conjunction with a straight up long S&P 500 portfolio. So why don't you walk our listeners through some of the basic methodology of your approach to this research, and then we'll get into some of the more specifics a little bit later.
Okay. Yeah, the basic idea of the paper is that because VolContract Futures is not yet trading, so we have to apply pricing model to calculate the theoretical historical VolContract prices first. And then after that, from those theoretical future prices, we can generate a return series from 1990 to 2012. And with that return series, we can do all kind of research. So after that, we used 3 different strategies for the one volatile portfolio. The first one is just simple buy and hold. And we found out that this strategy is not very good because although it reduced the standard deviation of the portfolio, the check on performance was so great that it is not expected to be a worthwhile endeavor.
Before you get even farther, let's just clarify that a little bit. So you compared and contrasted holding straight up holding the S&P 500 versus holding it with I believe it was a 10% allocation towards a vol contract type product, which obviously gives you a nice inverse correlation to the underlying and a bit of a hedge. And you determined from that it was the 1 month vol contract, I believe. And what you determined from that was that just like you said, the overall drag on returns wasn't worth some of the risk mitigation aspects it was bringing to the table.
Yeah.
Actually, what's interesting about this is Nick is selling himself a little bit short in the introduction and saying, we applied a theoretical model, and once we got these prices, we were able to study all sorts of strategies. The fact is, it actually took a tremendously long time and a great deal of false starts and going down wrong roads, if you will. This was a difficult process because, as Nick pointed out, we simply don't have any empirical data. There's everybody knows over-the-counter swaps are really kind of cloaked in mystery. You don't have any type of historical data, especially for volatility swaps, and there's really nowhere to go to get that kind of stuff. And the concept of having an on-exchange volatility type product for realized volatility, as everybody knows, just doesn't exist. So the first chore was to set out to try to actually create a theoretical value for what a vol contract would be trading at if it were up and running, with, of course, all the caveats and warnings about you don't always trade at theoretical value, and past performance doesn't indicate future results. But the bottom line is that Nick worked long and hard to incorporate a Heston pricing model and looked at many academic papers to look at swap pricing and try to come up with these values. And so he finally did. And then, of course, the search was on to see what using these in conjunction with an equity portfolio might be able to do in terms of enhanced returns or lower volatility, increased Sharpe ratio. So I'll turn it back over to Nick at this point, but I didn't want him to sell himself short at the monumental amount of research and work that was done just in order to be able to come up with theoretical values. So we're at this point now where we've got this data, and we say, what if we just buy and hold it? What if we take a 10% allocation, have vol contracts overlaying the portfolio, and just kind of leave them there, rolling them each month and seeing what that does? And I'll let Nick continue his narrative. The first finding was that we didn't do very well with that, right, Nick?
Yes. So because this strategy doesn't work out very well, so we trying to use a little bit more slightly complex strategy which applies a moving average. So we try 3 different moving average. Well, the first one is 252 days moving average. The second one is 63 day, and the third one is 21 day. And for all this moving average, when the moving average is going up, we allocate 0% to buying VZs. And when the moving average is going down, we allocate 10% into buying VZs. And from our research, we've shown that under this simple moving average strategy, the overall standard deviation again is reduced, and we have a higher return compared to the simple buy and hold strategy. But the problem is it is still not ideal because the overall performance still cannot beat the S&P portfolio.
Yeah, what was interesting here, as Nick pointed out, was that we actually, and we give credit to Bob Kraus for his suggestion in this area, we actually first examined, because some of the previous work in papers had indicated that this might be the way to go. Before hitting upon moving averages, we actually thought of something which to, I'm sure, all of our listeners would be somewhat more intuitive, and that was to try to play upon the mean reversion properties of volatility and to think about lightening up or perhaps not having any vol contracts at all when volatility was extremely high, because after all, we're buying these contracts. And if volatility spikes and then we expect a reversion to the mean over time, it might make sense to lighten up the allocation or not have any at all when volatility is at an upper 10, 20% range or at one extreme, and then to think about the overlay when volatility is actually very low, not only cheaper to be buying it, but also an indication of perhaps complacency and a market that has previously risen and that now might fall with the inverse correlation. But interestingly enough, that strategy didn't do well whatsoever. And I have to admit that I was actually a little surprised by it. I think the answer as to why buying low and either selling high or just getting no allocation whatsoever didn't work the way we expected is because these were 1 month volatility contracts. And as such, you don't always get reversion to the mean on demand, so to speak, or right away. Just because volatility is low and you buy something doesn't mean you're going to have instant gratification. And as a result, what we were finding was the returns were not enhanced at all. In fact, correct me if I'm wrong, Nick, but it actually kind of made things worse, didn't it?
Yeah. We actually get a portfolio that with reduced returns and higher standard deviations.
So that's about as embarrassing as you can get with everything going wrong. So it was back to the drawing board.
Especially with you guys and your just devotion to the Volcones, I would have assumed that A, that would be the first thing you guys would try because that's just second nature to you guys. And then B, I would assume like you that would be a fantastic strategy. But I guess once you factor in the time frame of those 1 month vol contracts, it becomes a little more difficult.
And I think that's what it was. And so, Bob hit upon an idea which perhaps made even more sense. And that was, since we do know of the strong inverse correlation, if you had any kind of indicator that worked with any kind of reliability such that it could actually foresee or predict market movement, perhaps that would be the way to go, letting the market kind of tell us what might happen to volatility. So as Nick just mentioned, when you had these moving averages and when simple moving averages crossed over, indicating a potential rise in the market, that was the time, interestingly enough, when, we didn't want to be in these contracts because we felt that they would coincide with drops in volatility. And then when the moving averages crossed the other way, and we thought that these were good predictors of falling markets, this was not only a time that we did want to be in vol contracts because we thought volatility would be increasing, but also because our portfolio of equities would be losing money. So obviously that was the right fit. So I'll toss it back to Nick and let him tell you a little bit more how that turned out.
Yeah, because many academic papers discuss how the inverse correlation between the realized volatility and rising market is not as strong as when the markets are falling. So in order to capture this bifurcation of volatility, we wanted to test one more strategy that is slightly more complex. We call this the dual MA strategy, which is a dual moving average strategy, because we applied 2 moving average indicator in this strategy. We did so by using a long-term moving average on the upside and a short-term moving average for the downside. In other words, we have 3 states. So the first one is when the long-term MA is rising, we allocate 0%. When the long-term MA is falling, we then look to the short-term MA. If the short-term MA is rising, we allocate 0%. And if the short-term is also falling, we'll allocate 10%.
So in other words, this was like a a two-pronged, or as you mentioned, a dual approach where we used one length or tenor of moving average to keep us away from upside, if you will, and the shorter term to confirm the longer term as to the down move. So we were really careful that we wanted like a confirmation that we thought the market would be dropping in order to make the allocation to the long side. And apparently, Nick, that worked out a little better, right?
Yeah, correct. So under this strategy, the one vol overlay portfolio not only beat the S&P only portfolio, it also beat all three simple moving edge portfolios we mentioned before in terms of performance.
That's an important characteristic, obviously, because people obviously look at these types of hedged and inverse products and think, well, on a risk-adjusted basis, they may be somewhere in the ballpark. But if you can also show them not just risk-adjusted, but on an overall return basis, that they're competitive, if not better, then that's a very dramatic result that I think will open a lot of people's eyes.
Well, you know what, Mark, we always talked about like the holy grail of investing. When you increase returns, you're not supposed to be able to do that and lower risk at the same time. You know, that's the best of both worlds. And so the ability to enhance the return while actually lowering the overall standard deviation a little bit was rather eye-opening, and obviously the kind of results that we were hoping for. So clearly we were kind of on the right path here. Nick, before you continue with this or any of the other strategies, it might be a good idea to talk about not only the overall period that we had, but the fact that we really did break this down into more than one category by date so that we would have returns and results for perhaps market disruptions or periods where, you know, there were some actually startling moves that might have had an effect on the strategy.
Yeah, we not only study for this one vol overlay portfolio for the whole period, i.e. From 1990 to 2012, we also break the period into another two sub-periods, which is the 2000 to 2003 and 2008 to 2010, which is the two market.
So you're talking about those very, very violent and very, very volatile points in the market. And it's certainly an interesting place to look at if you're looking at it from a volatility perspective to see how this strategy and these instruments performed in those very unique circumstances.
Yeah, so we had the technology bubble and the dot-com first one, and then of course everything having to do with 2008 Lehman and the financial crisis. And I don't think it's surprising to think that the losses to the portfolio were so great that in fact the returns were negative during those periods, but they were considerably less negative than just the naked, if you will, S&P portfolio, and with reduced volatility as well.
Hey, losing less is still a winner, right, Don?
Yes, yeah, cut your losses. That's part of the game.
I just came. Oh, go ahead, Nick.
Yeah, under those two periods, no matter what strategy you used, as long as you are buying the volatility future contract, you'll be lose less and you'll be having a better performance.
I just came back from a big Morningstar ETF conference here in Chicago a few weeks ago, and there were numerous panels and numerous discussions about this type of scenario where everyone was lamenting. Most of these were long-only asset managers and equity managers. All of them were lamenting the growing level of correlation across all asset classes and all of their traditional tricks, like having 20 different underlyings in a portfolio, or maybe adding in international names, or adding in perhaps commodities, or a little bit of that, whatever the case may be. All their traditional diversification tricks weren't working. And I talked to a lot of them about this exact type of point of adding some sort of volatility portion to their portfolio, because it truly is the only real true in this environment inversely correlated or negatively correlated asset class. And I think this type of result, even in those types of environments, would certainly raise a lot of eyebrows. Because like you said, Don, or like I said, I suppose, losing less is a winner in those environments, and people are really looking to preserve capital.
And now, Nick, there's a little bit more, right? You had to toss me at least a little crumb for the potential to actually sell these contracts on occasion. Listeners would be disappointed.
Don, I'm shocked. I'm shocked.
Aspect of that. So, Nick, tell them about that final piece of the puzzle.
Yeah. So we've been trying to use the dual MA approach, right? So we've been trying to avoid buying the VCs on the upside. So we think about what will happen if we short some VCs on the upside. So then our final strategy is when the long-term moving average is rising, we'll allocate minus 2%. In other words, we sell the 1.4 at 2% of the portfolio value, and everything remained the same, just as before. And under this strategy, our research have shown that the overall return has further increased with just a little bit slightly increased in standard deviation. If you look at the chart, it is amazing.
Yeah, we've got some pretty pictures there, and I might cut to the end, but there's still a little bit more to discuss, and tell our listeners that since the paper is just about 99% completed, it's actually being reviewed by some of the scholars and the professors at IIT, and perhaps we'll offer it to a few other colleagues and friends for their critical review. But it is our intention to make it available on the volx.us website very shortly. So I'll report back when the paper is available. And obviously, we'll have some conclusions as to further studies that might be possible, but I will simply reinforce that the final point that Nick made here was that if in fact you weren't going to buy these contracts, maybe it actually made sense to sell them at that particular point. And it wasn't surprising to find out, especially with the risk premium that we're all aware of, that selling them enhance the returns even more. You did give up just a little bit, and it wasn't dramatic, it was slight. You did give up a little bit on the standard deviation side, and that was expected. Since there's an inverse correlation, if you own the vol contracts and you own an equity portfolio and they move opposite a great deal of the time, you expect a dampening of volatility. Well, if you go ahead and you sell the vol contracts, then obviously you expect more in the sense of moving in the same direction rather than the opposite direction. So that does not dampen volatility, that increases it a little bit. And that simply comes with the territory of selling a volatility product in conjunction with an equity portfolio. The question is, do you get enough extra return for what you're doing to compensate for the slightly increased volatility? And the answer, at least as we found it, was yes, you do, because the increase in return is greater percentage-wise than the increase in standard deviation. So there is a slight increase and a bump up to the Sharpe ratio.
I think that's a surprising result to a lot of people who I think just naturally look at the concept of shorting volatility with a portfolio as being this tremendously risky proposal. I was talking to some financial advisors at a very large firm yesterday, I won't say which one, who who were limited to doing anything even close to like this because they thought it was just far too risky. And I was trying to walk them down to the dark side of even considering the idea. But this research like this, I think, will again be, very eye-opening to a lot of people who, listeners, you can't see all the pretty pictures that I'm looking at right now. Hopefully you'll be able to to see these charts and look at them for yourself very shortly on VolX. Maybe we'll link to it on the Options Insider as well, so you can see some of these results for yourself. But it is surprising, particularly if you manage this portfolio as you lay out here with the looking at the moving averages and then taking the combination of the vol contracts and going long and short and being a bit of a trader with it. It really is surprising the results that you can eke out of it with, I'd say, a relatively marginal increase in overall risk. Wouldn't you, Don?
Well, yeah, I think the point is extremely important that you make. Not only are we not claiming that you can simply blindly buy and hold and have a static overlay, because Nick began the entire presentation by saying that just doesn't seem to work. The draw on returns is too great to be buying this volatility premium on an ongoing basis. But in fact, the ability to tinker, if you will, and to have an active allocation clearly seems to be the way to go. And there were one or two other things that we considered, and then perhaps we'll summarize a little bit. So, Nick, I guess it wasn't much of a surprise that if we had a 10% allocation, that we toyed a little bit with the possibility of increasing that and bumping it up a little bit to see if holding vol contracts at the time that we thought was correct in greater percentage might do even better. So what were the findings there?
Yeah, as the final strategy using one vols, we consider allocate 20% when the short-term MA is falling this time, because we double the long volatility hedge to see if it can better protect the portfolio during the times of economic stress, with the hope of increasing the overall returns. And indeed, our research have shown that the returns of this portfolio have further increased, but with just a slightly increase in standard deviation. And the standard deviation is still lower than the S&P portfolio for the periods from 1990 to 2012, and for one of the subperiod from 2008 to 2011.
You know, it's this research to me is very analogous to a big collar study that the OIC did a few years ago, and they've been updating it every year since. And the results, I think, were similarly surprising on that end, where they proved that collars could be competitive, not just from a risk-adjusted basis, but from a total return perspective. And we're seeing similar results here. Instead of swapping out the collar for a inversely correlated or negatively correlated volatility asset, you can generate similar type results, which I think for a lot of our audience is a very interesting result. And Nick, I would just ask you this before we wrap up here. Obviously, you and Don have talked about putting this out to IIT and for academic review and perhaps tweaking some of the different methodologies. What's next for you on this study? Do you have a few more different, perhaps technical indicators you want to compare it to? Do you perhaps want to do an overall contrast of this performance versus, let's say, an S&P put or put spread or something like that, and perhaps some other comparing and contrasting research? Or what's next for you in terms of expanding this research?
I'm doing some research with the VolContract futures spread with the fixed futures, and we expected the spread in the anticipatory period of VolContract is going to be very small, and it is going to be a little bit larger in the realized volatility period. But I'm doing this right now. I'm still working on it yet.
So you know what's obvious there, Mark, and commenting on what Nick has just said, is that clearly we don't deny the existence of yet another volatility product, which is VIX, for the potential use in this kind of an overlay. And so what could be very interesting might be to consider the spreads between VIX futures and eventually VolContract futures, so that the active allocation and the active strategies could actually include switching back and forth, spreading from one to the other type contract. We've spoken a great deal and at length on the show about the differences between implied and realized and the traditional 3-4 percentage point spread. We've got a situation now where that spread is much, much larger. We talked about how it might contract. Maybe Mark Sebastian will comment on that as well. And as a result, the potential for this kind of a strategy to incorporate all the products that are out there and to potentially play off one to the other and include that in the strategy and the mix and the allocation might be all the more powerful and give even better results.
Well, Nick, I want to thank you for joining us on the program here today. This is, I think, for our listeners, is a very interesting aspect of research and certainly one that merits a lot of further study. So we're looking forward to seeing what you and Don and the rest of the boys over at VolX cook up. But in the meantime, we want to see this paper get finalized so we can, of course, put it out to our listeners and they could see for themselves what we've been talking about here and look at and compare and contrast some of the data so they could see how they could perhaps down the road someday incorporate similar techniques in their own trading. So, Nick, we want to thank you for coming on. We'll have to bring you on again down the road once the paper is finalized and you're working on some new aspects of this research.
Definitely. Thank you.
All right. Thank you for that, Nick. And that's going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball. And this is, of course, where we attempt to peer into the future and divine what the Vol gods hold in store for us for the coming week. And if today's action holds for the rest of the session and we close at these levels, it should make for a very, very interesting week next week indeed. So let's start off in VIX land. Monsignor Sebastian, what are you predicting? What are you looking for the week ahead from a VIX perspective? You think we're heading for more tumultuous times and 1% moves and things like that?
You got to realize volatility is going to tick up. We now have the VIX November future and the VIX cash almost on top of each other, which is bearish. And so I'm going to be really on the fence here as to kind of what we're going to see. You're not used to seeing this premium to cash really just topple like this. So, we may have a rough week next week. It's going to depend on earnings. But the interesting thing is, if we close where we are now, we'll still be up on the week small, despite all the horribleness. So we might have a little carry through. Don't be surprised if we get a dead cat bounce this morning, Monday. But maybe we're going to see the VIX threaten 18 or 19 next week.
You've been writing quite a bit lately on our site and on your blog about the concept of a hedged market and how people are hedging upside with VIX, downside with S&P and S&P put spreads, and therefore that translates into, at least in your opinion, why you think we've been seeing pretty much only upside vol for the most recent months. Now we have this, as we're recording right now, down almost 2% now in the S&Ps. So do you think we're finally breaking out of that hedged range?
It's possible. 14 and a quarter is really kind of the sticking point. So we've not broken it yet, but definitely on a Black Friday, on the anniversary of Black Friday, on a day where McDonald's, Google, IBM, GE, Microsoft, everybody crapped out, would not be surprised. I'm really on the fence. We still haven't gotten a full 2%, but I'm really on the fence, and I'll know in the last kind of hour of the trading day how I feel, but I'm starting to wonder.
That's where the rubber seems to hit the road these days. And not even the last hour, the last 5 or 10 minutes, it seems a lot of times.
I know.
These days. And we see all those gamma hedges and whatever other hedges flocking in and sending us and careening in crazy directions. I will put this out there for your consumption, Don and Mark, and do with it what you will. I was at a event for my son's preschool last night with a bunch of fathers, and there was a very diverse array of people there. And in the course of talking to random people, 2 people came up to me and mentioned, one of them said he just went out and bought I think it was SPY March puts to hedge. And then another one came up to me, and granted, he was a former trader, so he has some facility with the business. But the other one was just a generic financial advisor, doesn't know anything about this, and he was starting to tell me how he's starting to counsel his clients into some sort of VIX upside hedge. So there you go. Perhaps we've reached complete saturation. If use that as whatever contrary indicator you want to. Yeah, exactly. I think if that's the truth, we're turning around.
There's hope for the market after all.
Yeah, exactly. I was not expecting to hear both an S&P downside and a VIX upside hedging discussion in the course of this very random event. But there you go. You do with that what you will. Don, what say you, sir?
Well, I'm kind of torn the way Mark has just indicated. I have to be honest and say I really don't know here. I really don't know on the other weeks either, but I make believe that I do. So yeah. in this particular case, what we know for sure is the volatility of this particular day is certainly going to impact realized volatility. So we're going to start off with that bump up. Whether it's going to continue throughout the week or not remains to be seen, but obviously there's just no denying this inverse relationship and the fact that you're going to see increases in both realized and implied volatility if the market continues to drop. So I think this is really one of those times where, you have to look to what your prediction of equity direction is going to be to help you in your forecast of what's going to happen with volatility. But
Don, I've been saying that I'll believe that we're kind of going to have more volatility when I actually see some volatility. And if that's what I've been saying, then, this is my line in the sand right here, isn't it?
Yeah, absolutely. I think what's interesting, Nick just had this interesting discussion about theoretical pricing of vol contracts. And of course, we already have VIX futures trading, but this is a different kind of a calculation. And I've mentioned this before on the show, but it bears repeating on a day like this. Sometimes when we spoke to people about the calculation period and accumulating the returns, and when you would get deep into that calculation period, or what we call the realized volatility period, people would say, oh, well, when you got 19 or 20 data points and, practically the final value is known, what could one more day do? Why do I want to stay in such a product? What can I get out of it? And the answer is you can get quite a bit on a day like this. So if this were the last day of a realized volatility period with NASDAQ, and we started out with a 13 price and we had only 1 day to go and 20 days were in the bag, I just did a quick calculation, and with a 2% move on a day like this, that 13 would go up to 14.5. So that's 1.5 points on 13. That's an 11.5% increase in that particular asset on the last day, even when 20 days are already calculated and in the formula. So days like this just go to show how, these instruments are going to have desirable trading properties right up until the very end.
Mark, the one thing I will say is that I happily used we like to call the John Griegas indicator, and my Groupon bear trade is working out.
I was going to say that Groupon trade looking pretty good right now. Groupon is looking pretty ugly. AMD also looking pretty ugly, which is a fun, because we were talking about that joke strangle on that show last week, and that one has paid off fairly well.
My only regret is that I actually did a 2x3 instead of the full just straight long puts.
You got to hedge somewhat in this environment. I will add one final data point to this discussion for the listeners' edification as a contrarian viewpoint. I myself was working a downside put spread in the S&P and a ratio put spread in Ford yesterday. I missed both of them, so by my fortune, that means we're off to the races on the downside now, and I've missed all of my hedging opportunities. So take that for what you will, listeners. We could be in for some more choppy, rough 1% down days in the near there to come, and perhaps with Groupon's an indicator, everything's going to hell in a handbasket very quickly. But yeah, an interesting day today. I think an interesting week from a volatility perspective, and I think we can definitely look forward to more of this at the very least in the very near term. Listeners, if you'll be listening to this on Monday morning, so you'll be able to see exactly what we're in store for on Monday, but should be an interesting day. And of course, before we go, we want to thank Nick Lee again for joining us in our Volatility Viewpoint. Some very, very interesting discussion points there. I think I'm looking forward, Don, I don't know if you have a time frame yet, but I'm looking forward to getting my hands on the actual paper and being able to put it out for our listeners so they could see some of those data points we were discussing during the conversation.
I think it should be really a matter almost of days and not weeks. And we really hope to not only make this available, but make some of the historical pricing data potentially available so people can play with their own strategies. I think, as with any study, the important takeaway from something like this is not just simply our findings with a particular set of rules or strategies or allocations that we came up with, but a jumping off point as a flexibility for any investor, any trader, any hedge fund or portfolio manager to understand that there's a tool out there that could play a very important role and could be an extra, added tool in the arsenal. And so it'll be up to investors to start making these discoveries for themselves, different allocations, different strategies, and hopefully lots of people will be writing papers about some of the effects and some of the benefits of incorporating volatility as a kind of an asset class into an equity portfolio.
And I'd imagine we always close the show talking about what's coming up in the land of VolX.us. I would wager that is probably the next big thing to come on the old website, that study.
Well, I'm sure that it is. And, we continue to add new papers to the volatility library. This may be one of the cornerstones, but just to remind people that for a research tool, if you're doing studies on volatility and you want to go to one place where are kind of amassed or organized a tremendous amount of academic papers and studies on all forms of volatility, go to the volx.us website on the pull-down menu to research, and then go to the volatility library. And I think you'll be rather favorably impressed by the collection of scholarly and academic studies that you'll find there.
And if you're in the mood, dear listener, for an extensive day full of volatility chat, then I think you'll like the event that Mark and the folks over at Option Pit, as well as the folks over at the CBOE's Options Institute and even the Street are putting together for you. I believe it's on the 10th of November. Is that correct, Mr. Sebastian?
Yep.
So listener, yup. Very, I'm trying to give you a big plug here, and I get yup.
Yeah, no, it's going to be a lot of fun. It's an all-day event on Saturday. It's me, Jim.
Yeah, we'll do that.
Yeah, sure, whatever. Show up if you want.
It's the 10th. No, everybody should. It's going to be a great day. It's me, Jim Bittman teaching. We're going to talk about volatility, earnings, how all these things kind of intersect. We'll talk a little about the VIX equity ETFs, things like that.
You can spend half that day just on the destruction of TVIX and the debacle that was. Mm-hmm. So listeners, if you want to check that out, then by all means surf on over to optionpit.com. I believe it's /events where you can find more information about how to register for that, so you can have a whole day of Mark Sebastian just to yourself. And that, of course, is going to do it for us here on the old Vol Views panel. I want to thank my cohorts, my partners in crime, for joining me on the show today. And we, of course, want to thank all of you for listening and streaming and subscribing to the program. We didn't have a chance to get to the mailbag today, but that's, of course, because we had such a great guest on the show. We'll get to the mailbag again in future installments, though it will be a little bit more infrequent because we have so many great guests lined up. I think that's a trade-off most of you listeners are willing to make. So if you are writing in, we'll get to you in a future show. Of course, you can reach us questions at theoptionsinsider.com. Just put question for volatility views in the subject line, or you can get us on our comment system on the site, or you can find us on Twitter or Facebook. There's a lot of different ways for you to reach out to us and get your questions featured on the show. But for Mark and Don and all the rest of us here on the Volatility Views panel, we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.